Hello, welcome to Morris Money, where we give you stock tips in under 5 minutes. I'm your host, Morris Willie. The Wild West was a rough and untamed landscape. Let me tell you how people got by. They got by subscribing to Morris Money. Today, I'm talking about should you buy Two Harbors Investment TWO, and if their dividend could be coming to a halt. Last year was awful for the mortgage space. As the Federal Reserve hiked interest rates, mortgage orientation companies saw volumes collapse. Mortgage real estate investment trusts, REITs, saw the assets in their portfolios take a beating. Most mortgage REITs saw big declines in book value per share, and many were forced to cut their dividends. Two Harbors Investment was one of the REITs that cut its dividend. That said, the worst might be over for the space. Two Harbors is an agency and mortgage servicing REIT. It invests primarily in mortgage-backed securities, which are guaranteed by the U.S. government. This means that Two Harbors bears little credit risk on its mortgage-backed security portfolio, but it can be harmed by interest rate movement. Agency mortgage-backed securities struggled in 2022 as the Federal Reserve aggressively hiked the federal rate funds in an effort to rein out outsized inflation. This caused mortgage-backed securities, MBS, to underperform treasuries, which translated into declining book values for the mortgage REIT sector. Two Harbors also holds a large mortgage servicing portfolio. Mortgage servicing is an unusual asset. Mortgage servicers handle the administrative tasks of a mortgage on behalf of the mortgage-backed security investor. The servicer sends out the monthly bills, collects the payments, forwards the principal and interest payments to the investor, ensures property taxes are paid, and deals with delinquent borrowers. The mortgage servicer is generally paid a fee of 0.25% of the mortgage loan per year as compensation. So if the mortgage is $400,000, the servicer gets paid $1,000 a year. The right to perform the service is worth something, and Two Harbors includes it as an asset on its balance sheet. Mortgage servicing is usual as it increases in value while interest rates rise. This is because the chance of a loan getting paid off early declines. This means that the mortgage servicer can expect to get that 0.25% fee for a longer period of time. The average interest rate on a loan in Two Harbors servicing book is 3.27%, with the average mortgage rate at 6.5%. Rates would have to fall by a lot to bring the refinancing option back into consideration. Two Harbors is valuing its servicing book at 5.5 times the annual servicing fee, which is on the high side. If rates begin to fall or delinquencies pick up, that multiple will fall. The mortgage-backed security portfolio struggled last year as mortgage-backed securities spreads widened. This means that MBSs or mortgage-backed securities underperformed treasuries. From the beginning of 2022 to the end of the third quarter, book value per share fell from $23.47 to $16.42. MBS spreads peaked in October and have narrowed since. This spread narrowing drove an increase in book value per share to $17.72 in the fourth quarter of 2022. If MBS spreads continue to narrow, Two Harbors could see future increases in book value per share. One of the determinants of mortgage-backed security spreads is interest rate volatility. Volatility means that security prices are moving quickly and often. Volatility is bad for MBSs in particular, and this was one of the reasons why those securities struggled so much last year. The Fed funds futures indicate that the Federal Reserve is close to wrapping up its tightening regime, which will support MBS prices and should help narrow mortgage-backed security spreads. Two Harbors cut its quarterly dividend from 68 cents per share to 60 cents per share. That said, earnings available for distribution were only 26 cents last quarter, so the dividend still wasn't covered. In the quarterly presentation, Two Harbors management said that earnings available for distribution were expected to moderate over the next several quarters and that it could diverge from expected ongoing earnings power. Maybe Two Harbors will be able to maintain the dividend if earnings available for distribution fall, but another dividend cut seems like a risk. And a risk it could be. But let's go to Wall Street real quick. What does Wall Street think? 9 analysts covered Two Harbors investments, with 2 rating it a buy and 7 rating it a hold. So giving it an overall hold with a price target right now of $17.44, giving it a potential upside of around 27% from this level. But let me know down below, what do you think of Two Harbors investment, and what do you think about the REIT? Let me know all your thoughts down below. Please don't take this video as financial advice, and thank you for watching Morris Money.